Welcome back to Noble Billion News, where we break down the real movements happening in the world of gold, silver, and platinum. Today's story may sound like good news at first, but there's another side to it that investors must pay attention to. No matter how you look at it, something big has happened at the Royal Mint, something that could impact every single person who stores their wealth in precious metals. Stay with me, because what's happening right now is not just exciting, it's also a signal that the market is shifting in a serious way. And by the end of this analysis, I'll explain why this record-breaking event might be a warning as much as it is a celebration. So the big news is this. The Royal Mint has received record-breaking inflows into physical gold, silver, and platinum. This is not ETF flows or paper contracts. This is real metal that people are taking delivery of. And that tells us one thing very clearly. Investors are waking up. They are moving out of risky assets and searching for safety in metals that have protected wealth for thousands of years. Many analysts are saying that this shift reflects deep economic anxiety after months of global volatility, and honestly, I agree. People don't buy physical metal unless they feel something is wrong with the economic outlook. What makes this even more interesting is that this surge covers all three metals: gold, silver, and platinum. Usually, platinum doesn't join the party. Platinum is mostly driven by industrial demand, especially automotive catalysts. But the fact that platinum is also catching investor attention means people are broadening their hedge. Some economic experts, like Professor Mark Jensen from the UK Metals Research Institute, say this is a sign that investors no longer trust traditional safe havens like bonds. Others argue that because platinum is undervalued relative to gold, people see it as a bargain play. My own view sits somewhere in the middle. Platinum remains volatile, but when fear rises, its low price makes it look appealing. Now, Kitco recently reported that investment demand is the main engine of gold's massive third quarter rally, hitting new records around $4,360 per ounce. That number alone would shake anyone awake. But I partly disagree with Kitco's conclusion that the rally is driven mainly by retail investors. Central banks around the world have been buying gold aggressively. When big institutions accumulate metal, that pushes prices much more than small buyers do. Gold is deeply treasured culturally, financially, and historically. So while retail demand is growing fast, institutional demand still plays the bigger role. Silver, on the other hand, continues to lag behind in institutional interest, but private buyers, especially outside the US and UK, are increasing their silver stacking significantly. And before we move deeper, let me remind you, if you ever buy from major mints, including the Royal Mint, always compare prices. Some dealers offer better spreads and better availability. But the important point today is this: inflows are rising everywhere, not just in ETFs. People want physical metal. The Royal Mint's latest performance has surprised even veteran analysts, and the numbers are nothing short of extraordinary. Investors poured into precious metals at a pace that the Mint hasn't seen in modern history. According to internal reports, bullion coin sales revenue jumped an incredible 102% compared to the same quarter last year. That means the demand didn't just rise a little, it more than doubled. Even when compared to the previous quarter, sales still climbed another 6%, proving this is not a temporary spike. This kind of growth shows that precious metals are becoming a critical part of wealth strategy for people across the UK and beyond. The Mint doesn't give exact unit numbers, but the revenue jump alone reveals how aggressively people are buying. Gold coin sales rose around 5% quarter on quarter, which may sound small compared to silver's massive gains, but it's important to understand the psychology of buyers. Gold is expensive, and when prices reach record highs, some investors hesitate. Yet even in this environment, gold coin revenue still grew, which means people are willing to pay premium prices to secure real metal. Silver, however, had a truly explosive quarter. Coin sales surged 44% from the previous quarter and 83% from last year. This is a clear signal that everyday people, new stackers especially, are entering the market or increasing their holdings out of concern for the future. Silver is accessible, cheaper per ounce, and emotionally easier to buy in bulk. So when fear rises, silver tends to get attention quickly. What surprised many analysts was how well the Royal Mint's digital metal products performed. Their VAT-free DigiGold system saw inflows rise 156% from the same quarter last year. That's a dramatic shift, and economists like Sarah Donovan from the London Economic Forum say the main reason is convenience. People want exposure to gold without the complications of storage or the burden of paying VAT on silver. My view is slightly different. I think digital metals are becoming popular because young investors prefer simple buying interfaces, similar to crypto platforms. It's not that they don't trust physical metal. It's that they want speed and flexibility, especially during uncertain markets. But here's where things get frustrating. The UK's VAT tax on newly purchased silver remains a major obstacle. While other countries treat silver as a monetary metal, the UK treats it like a consumer product, adding an unnecessary layer of cost. Many analysts call this tax outdated and harmful to the market. I agree completely. It discourages stacking and pushes buyers towards secondary markets where VAT is not charged. It also prevents silver from reflecting its true market potential. Platinum suffers less from this issue because fewer people buy it regularly, but silver is where the damage is most visible. Despite these challenges, both silver and platinum reached all-time high investment inflows, partly because investors rotated away from gold after the strong gold rally. For some, silver appears undervalued. For others, platinum is appealing because of its industrial demand and extreme rarity, about 15 times rarer than gold. Analysts disagree about which metal is the better play, but most agree that the trend clearly shows people are searching for alternatives as gold becomes more expensive. My view is that diversified stacking remains the smartest approach, especially during this kind of transitionary period. As we move deeper into the Royal Mint's record-breaking surge, it becomes clear that this trend is not happening in isolation. Around the world, geopolitical tensions, inflation pressure, and weakening trust in banking systems are all contributing to a heightened sense of uncertainty. When people feel unsure about the future, they instinctively turn toward hard assets, something they can hold, something that doesn't require permission or trust in a third-party system. Stuart O'Reilly, the market insights manager at the Royal Mint, stated that both new and experienced investors are moving toward precious metals because of this exact uncertainty. His comments match what many global analysts have been warning. People are beginning to hedge against long-term economic instability rather than short-term market swings. According to O'Reilly, the Mint saw a 70% increase in new purchasers in October alone. These new buyers also spent nearly double what last year's buyers did during the same month. That kind of growth is not normal. It tells us that something has shifted in the mindset of average citizens. Economists like Dr. Helen Crawford from the International Wealth Institute believe that this shows deep concern about the declining value of currencies like the pound and the dollar. She argues that, with inflation still lingering and governments taking on record debt, people no longer fully trust traditional savings vehicles. My own view aligns with hers. When a currency loses purchasing power year after year, people eventually seek protection. And precious metals historically provide that protection when everything else becomes questionable. But the story becomes even more intriguing when we compare this demand with what's happening in other countries. The World Gold Council recently reported that the United States was the only major region where physical gold demand actually fell year over year. This contrast is significant because it tells us that investor sentiment is not the same everywhere. In countries like the UK, Europe, and parts of Asia, people are buying more gold and silver because they see economic trouble ahead. In the US, however, many investors seem focused on short-term market optimism, the stock market bounce, and high-yield savings accounts. But as many analysts warn, this optimism may be temporary. Precious metals often lag behind economic fear cycles, meaning US investors could eventually catch up to this global shift once economic pressure intensifies. Gold's rising price is also playing a big role in how people behave. With gold touching new highs, some believe the metal has reached a level where new buyers hesitate. They feel it might be too late to enter. As a result, people begin exploring alternatives like silver and platinum. Silver, being relatively undervalued compared to its historical gold ratio, feels like the affordable entry point for many. Platinum, on the other hand, appeals to more strategic investors because it is extremely rare and deeply linked to industrial growth. But platinum also carries high volatility, which scares some buyers away. Analysts like Thomas Rayner from Market Metals Group suggest that platinum may outperform in the long term as industrial sectors expand, while silver could remain the most accessible hedge for average people. Personally, I believe all three metals have their role, but gold remains the foundation. Silver is the accelerator, and platinum is the wild card. What many people misunderstand is that rising demand doesn't always mean prices will continue climbing forever. Markets don't move in straight lines. There are always corrections. There are always consolidation phases. This is where some of the hidden risks appear. If new buyers enter the market expecting gold and silver to keep rising non-stop, they may feel discouraged when the inevitable pullback comes. That emotional shock leads many to sell at the worst possible time. That's why it's important to understand the long-term nature of stacking. Precious metals are not meant to be traded like tech stocks. They are meant to be held with discipline and confidence. As the conversation expands beyond pure investment demand, it's important to understand another major force in today's precious metals market: the influence of collectible coins and limited mintage products. While most long-term stackers focus strictly on bullion for wealth preservation, there is also a growing segment of buyers who appreciate craftsmanship, rarity, and artistic value. This collector interest has become especially strong as mints worldwide introduce unique designs, themed series, and high-quality finishes that appeal not only to numismatists, but also to new investors who want something visually meaningful. A good example is the latest release from the Germania Mint, which sent out a striking octagon-shaped coin from its well-known witchcraft series. These kinds of pieces, while not intended as pure bullion investments, create emotional attachment and diversify the reasons people enter the precious metal space. Some analysts believe collectibles attract buyers who might later migrate into bullion stacking, slowly building a foundation of precious metals for long-term security. Others argue that collectible markets can be risky because premiums are unpredictable and future resale value is not guaranteed. My own view sits in the middle. Collectible coins should be enjoyed for their beauty and craftsmanship, not relied upon as guaranteed profit engines. The Germania piece, for example, is visually stunning and limited to only 10,000 pieces, which gives it scarcity value. But like all collector's items, prices can rise or fall depending on trends, community interest, and overall market conditions. This is why I always remind people that bullion is the backbone of a solid metal strategy, while collectibles are the optional luxury layer on top. While the artistry side of the market continues to grow, the fundamentals driving precious metal demand remain tied to global uncertainty. And this is where some people misunderstand what is happening. They see rising sales at the Royal Mint as purely bullish news, an unstoppable wave that will push prices higher and higher. But in reality, rising demand often signals deeper economic concerns. When the average person starts converting their cash into metal, it usually means confidence in the financial system is slipping. This is exactly what experts like Andrew Bishop from the Global Markets Council warn about. He states that a surge in physical metal buying tends to be a fear indicator, reflecting anxiety about inflation, currency weakness, or geopolitical turmoil. And historically, when fear peaks, markets often follow with sharp corrections before stabilizing. These are the risks new stackers need to understand. Precious metals are powerful tools for wealth protection, but they are not a magic ticket to quick profit. In fact, once demand becomes extremely high, like what we are seeing now, the possibility of a price correction increases. A correction does not mean the metals are failing. It simply means the market is adjusting after strong momentum. Investors who panic at this stage often sell at a loss, while seasoned stackers hold steady and come out ahead in the long run. Economic historian Dr. Leonard Hayes explains that every major metals rally in the past 70 years was followed by a period of price consolidation. This is normal. This is healthy. And this is where discipline matters more than excitement. With gold at record levels, silver pushing new highs, and platinum climbing due to renewed industrial strength, we are entering a phase where emotional reactions can be more dangerous than market movements. Many people get caught up in the rush, seeing others buy, seeing headlines about records, and assuming the climb will continue forever. That's not how wealth preservation works. Metals reward patience, not impulsiveness. As we reach the final part of this analysis, we need to confront the part of the story that most new investors overlook. The reality that every major surge in precious metals is followed by a moment of cooling, adjustment, or even sharp correction. This does not mean that gold, silver, or platinum are in danger. It simply means that markets breathe. And right now, with demand hitting all-time highs at the Royal Mint, with digital gold inflows rising more than 150%, and with global uncertainty driving people towards safe haven assets, the market is heating up faster than usual. Whenever things heat up too quickly, history shows that a period of consolidation is not only possible, but highly likely. Analysts like Jeff Harding of the Market Institute warn that euphoria is always the last stage before stabilization, and this same pattern has repeated in every precious metal cycle of the last century. This is where the bad news comes in. Not because metals will fail, but because many new stackers enter the market with unrealistic expectations. They see the headlines, they see record sales, they see gold touching new highs, and they assume the next step is an endless climb. But economic cycles never move in straight lines. Dr. Elena Cross, a senior commodity strategist at Cambridge Economics, says that when demand spikes suddenly, the emotional side of the market becomes stronger than the rational side. People start buying because others are buying, not because they understand long-term value. And when that happens, corrections become sharper, catching inexperienced buyers off guard. Many newcomers are shocked when the metals they purchased fall in price right after they buy them, thinking something went wrong. But nothing went wrong. That is simply the market returning to normal rhythm. This is why long-term discipline is the most valuable asset a stacker can have. The real purpose of gold and silver is not to chase a quick profit. It is to preserve stability in a world that becomes more unpredictable every day. Precious metals are money outside the banking system. They have served as real wealth for thousands of years, long before the stock market existed, long before modern governments rose or fell. When you buy metals, you are not buying excitement. You are buying time, protection, and independence. My own analysis has always supported this view, and it aligns closely with voices like Lynette Zhang and Peter Schiff, who emphasize that metals are about survival of purchasing power, not speculation. And this is why seasoned stackers talk about holding with diamond fists. Not because it sounds dramatic, but because it reflects the mindset needed to manage volatility. Whether prices rise or fall, whether a correction appears tomorrow or next year, the true strength of precious metals is realized only when held through every phase of the economic cycle. Silver may dip. Gold may consolidate. Platinum may swing more widely than both. But over decades, metals have always outlasted inflation, currency decay, and political uncertainty. So, as we wrap up this deep dive, the message is clear. The record-breaking demand at the Royal Mint is not just a headline, it's a signal. People are quietly preparing for an unstable future, and the smartest approach is to prepare calmly and consistently, not emotionally. Keep stacking responsibly, hold long-term, understand the market's rhythm, and remember that in the world of precious metals, patience is far more powerful than excitement. Thank you for watching Noble Billion News. I appreciate every one of you who takes the time to learn, think, and prepare for the future. If you found value in this breakdown, make sure to like, share, comment with your thoughts, and subscribe for more expert economic insights. I'll see you in the next one. Stay strong, stay informed, and keep stacking smart.